Welcome to the Real News Network. I'm Paul Jay in Baltimore. This is the second part in our series of interviews about offshore tax havens. Somewhere between 20 and 30 trillions of dollars, says a new study, is being stashed in these various tax havens to avoid tax primarily. Now joining us to continue this discussion is James Henry. He's an economist, an attorney, investigative journalist. He was a chief economist, I should say, at the international consultancy firm McKinsey & Company. And he's the lead researcher of this report titled The Price of Offshore Revisited. He's also a global board member of the Tax Justice Network. Thanks for joining us, James.
Well,
so how many people are we talking about? Like, how many people are rich enough and are taking advantage of these tax havens? And give us again the sense of the kind of money involved.
Well, when you look at the distribution of wealth here that's offshore, we think there is no more than about 10 million people that really account for about 83% of the 21 trillion that is at a minimum offshore. And that's pretty concentrated. The top 100 are multi-billionaires. They account for about 8.1% of the total. The next 2,900 billionaires with an average wealth of $1.4 billion account for another 7% of it. So that's, that's about 3,000 people that already are owning nearly 15% of the world's financial wealth. And then we have the next step in the ladder is the sort of ultra high net worth crowd, which are their average wealth is on the order of $58 million, and there's about 117,000 of them in the world. And then finally, there's another fortunate few who are about 9.9 million, whose average wealth is on the order of 6.3 million, and they account for about 60% of this. So 82% of the world's wealth then is, when you add all this up, is the offshore wealth is owned by about 0.14% of the world's population. So if you look at it from the standpoint of who's actually benefiting from this industry, it's a tiny share of the global population. And that group, as in terms of global wealth, which is about $231 trillion, they own about a third of all that global wealth. And so that's 0.14% is a tiny fraction owning that much wealth.
You do a calculation in your study about what kind of tax revenues might be derived from this if this was taxed.
It's a calculation, a rough estimate that somewhere between 250 and $300 billion a year of revenue, if all this money were, all this wealth were really declared and the earnings on it were, and that's assuming kind of a very conservative 3% yield on the wealth and a 30% marginal tax rate. So it could be far higher than that depending on the year. Obviously, it's presumptuous to assume that tax authorities are ever going to be able to get people to declare this income, but the option that we're suggesting is that, since it's concentrated in these big banks, we could imagine having a 0.5% annual withholding tax on this wealth that would be easy for the banks to implement. They know what these folks' wealth is every quarter because they have to report to them. And if it was just 0.5% applied to these anonymous assets, you might generate, somewhere that would be big enough to basically pay the world's aid budget, which is about $89 billion this year. So we're talking about, if you want to talk about in occupied terms, the top 1% of the world's population now owns about 61% of all financial wealth and 100% of the offshore wealth that we're talking about in this study.
And what are the consequences of this on the global economy that so much money is sitting in these tax havens?
Well, first of all, we know that inequality is understated. The standard statistics for inequality leave out all this wealth, and even though it's only 10% of the world's total wealth, it all accrues to this tiny fraction of the population. So that means that the Gini statistics, all the other kind of routine statistics we've used to measure wealth inequality are understated. And secondly, we've also understated the growth of inequality because all of this activity is relatively new in world history, and so it goes back to the beginnings of the 1970s when havens started to take off, and then a lot of this offshoring of wealth started to soar, partly financed by the debt crisis, partly because the haven infrastructure was being refined by these banks. And since then it's taken off. And we've learned a lot more lately about the impact that inequality really has on welfare, on people's lives, on the performance of the macroeconomy as well. For example, one characteristic of all this wealth is that it's invested in relatively low yielding time deposits and secure assets in first world countries. And compared with investing in a high growth developing country like Brazil, the opportunity cost is really pretty high here for this kind of investment. And the people who are this wealthy are not consuming. I mean, they've consumed about as much in the way of real estate and yachts and art and other things as finer things in life as they can. But at the end of the day, they are almost required to save it. So they do consume a lot of political power, which seems to be an outlet for virtually unlimited expenditures. But aside from that, they're not creating a lot of jobs with their savings here.
The theory is supposed to be that if they have this much capital, they're going to invest it. Are they not?
Well, as Keynes pointed out back in 1936, the problem is that in the capitalist economy, investment depends on expected profitability, and savings can be made for other reasons. In this case, just because distribution of wealth favors people who don't, it's far too much for them to consume. So there's no necessary coupling between savings and investment unless business people really expect the economy to get better. Right now, we've seen that the investment side is very weak. So when you have all these people, just necessarily saving rather than consuming, it's in a recession environment, it makes things worse.
And I suppose if the underlying motivation here is tax avoidance, which is why you have this money in these shelters, I suppose it's not so easy just to take it and then start investing it anyway, is it?
No, it's not easy at all. I think you'd imagine that if this wealth were taxed and the funds were distributed to the poor or to needy people, or sort of people with higher propensity to consume, that would have some stimulating effect we're not seeing from all this wealth inequality. This is a political phenomenon. The regulations are designed in Washington and in the city of London and in the leading capitals of first world countries partly by an industry that has enormous stake in this game. Not only these wealthy clients, but the banking industry. For them, this is a matter of billions of dollars a year of profits and a lot of shareholder value. They are spending too heavily on campaign contributions and on lobbyists to make sure that their point of view is represented. Anytime there's a treasury regulation, anytime there's a major prosecution of a major bank, you can be sure that they are there helping to write the regulations and lobby against the prosecution. So in the last, since 1990, I calculated that the U.S. banking industry, for example, has spent about $6.6 billion on campaign contributions and lobbying in Washington alone. It's about $2,200 per congressman per day since 1990. And that's one of the reasons we're seeing this kind of result.
Now, if a big bank helps someone from a developing country to avoid taxes and or embezzle a public treasury and then park this money in a tax haven, that's a criminal conspiracy, one would think. And there is an argument that's been made, I think by one of your colleagues too, James Boyce and others, that there's historic precedent for then the countries to say, well, banks, you did this knowingly, and now you're lending us money, and we're in debt to you, although on the whole, we'd actually be a creditor if we could repatriate all this money that you colluded with. So maybe we don't owe you this money, and I think the concept is called odious debt. What do you make of that?
Yeah, well, I'm familiar with that argument. It dates back to the United States intervention in Spain, in Cuba in 1898, where they ended up basically forgiving Cuba's debt to Spain because it had been imposed on them by a dictator. Unfortunately, the United States has stopped using that doctrine elsewhere or generalizing it. It doesn't really help us with these offshore assets. It would help us forgive some of the debt that developing countries still have. But in terms of this situation, you have global private bankers basically helping the money to go out. Now, I would argue that the analogy really is to the kind of prosecutions that the U.S. Justice Department has been making against UBS for helping wealthy Americans take their money abroad. And we've already seen several private bankers go to jail. We've seen UBS heavily fined. The Justice Department just levied a $1 billion fine against HSBC for facilitating $14 billion of money laundering for the Colombian Mexican cartels. But these major institutions which are involved in this, HSBC is, by the way, the third largest player in this particular private banking industry that we're seeing here. They serve about $633 billion of offshore private wealth, and puts them number 3 on the list. But basically, the point is that developing countries might also want to take advantage of making the exact same argument against these banks when they come to Mexico or the Philippines, to try to take money out there, and basically enabling all of this kind of funny business. But we haven't seen such prosecutions, and it's for no accident. I mean, I've tried to understand why, for example, the Philippines, which was a major victim of bad banking by the foreign banks that were looking the other way while Marcos ripped off the central bank of the Philippines for billions and billions of dollars parked in Switzerland. And the Philippine government was left holding the bag for that debt. I asked the Philippine ministers at the time why they didn't go after these people. They said they were basically intimidated by the international banks, and felt that the Philippines couldn't really have any bargaining power with them. So this is something that's very difficult for any individual developing country to tackle, because the banks quickly, gang up on them and will make life hard, single them out, and move elsewhere. But
right.
It is something that cries out for collective action.
Well, in the next segment of our interview, we're going to talk about what that collective action could look like and what Americans might be demanding of their government on this score, given that all of these big banks, one way or the other, are touched by American regulation or lack thereof. So please join us for the next segment of our interview, and we will be back soon on the Real News Network.